Most people think the economy is a ladder. If you work hard enough, climb long enough, save consistently enough, you eventually rise. That's the illusion, because what if the system you're reliving inside wasn't built like a ladder at all? What if it was built like a funnel, wide at the bottom, narrow at the top, carefully designed so that no matter how much wealth enters, it always flows upward? What if the financial rules you were taught to trust, interest rates, inflation, bank deposits, savings accounts, mortgages, weren't just neutral tools, but engineered mechanisms that quietly tilt the playing field? What if the real purpose of the modern economic system isn't wealth creation, but wealth extraction? And what if this design wasn't an accident, but the result of a century-long evolution, rarely noticed, never voted on, and almost impossible to escape from? Today, you're about to see how the illusion works, how it started, how it spread, and why it keeps repeating generation after generation. Let's begin where the illusion was first constructed. To understand the system, we need to travel back to the 1800s, before digital money, before global markets, before central banks ruled the world. The world's economic system was simple. Money was metal, debt was limited. Banks could fail without destroying entire nations. Wealth was something you physically held. There was no illusion yet. But during the Industrial Revolution, something changed. Factories grew, empires expanded, the demand for capital exploded. And early financial elites realized something crucial. Growth was limited by real money. Gold couldn't be mined fast enough. Silver couldn't be transported fast enough. Physical money couldn't scale with the ambitions of governments and industrialists. So financial innovators began experimenting with a dangerous idea. What if money didn't have to be real? What if it could be promised instead? This was the seed that would grow into the largest financial transformation in human history. Banks began issuing claims on gold instead of gold itself. Governments printed notes redeemable for metal they didn't fully possess. Debt became the engine of expansion, and with each small step away from hard money, the door opened for something new, a financial system where wealth no longer flowed naturally, but by design. Fast forward to the early 1900s. Financial panics were destabilizing nations. Bank failures were wiping out savings. Governments were desperate for stability, and in that desperation, financiers and policymakers came together to craft a new monetary architecture, one that looked stable, but quietly shifted power upward. The most important turning point: the rise of central banks. The US Federal Reserve in 1913, the Bank of England's consolidation, European central banking reforms, Japan and others following the blueprint. These weren't just institutions, they were gatekeepers. Gatekeepers who could create money, decide interest rates, control credit, influence asset prices, shape economic booms and busts. And here's where the illusion began to take shape. When money creation becomes centralized, so does wealth. If a small group can expand or restrict money at will, if they can control the cost of borrowing, if they can pump liquidity into financial markets, then the people closest to that power benefit first. Banks, large investors, wealthy political insiders, they gain early access to new money before the rest of society experiences the inflation. This became known as the Cantillon effect, and it built the foundation of a financial system that naturally funnels wealth upward. But the real twist was still decades away. From 1944 to 1971, the world lived under a gold-backed system called Bretton Woods. It was a simple structure. Currencies were pegged to the dollar was pegged to gold. Nations trusted the dollar because America promised convertibility, but behind the scenes, cracks were forming. Governments wanted to spend more. Wars demanded funding, social programs expanded, economies needed credit, and the gold supply couldn't keep up. By the late 1960s, the illusion was exposed. Countries lined up to redeem their dollars for gold. US reserves were draining. Confidence was collapsing. So in 1971, President Richard Nixon made a decision that transformed global finance forever. He severed the link between the dollar and gold. Overnight, money became 100% fiat, value became trust, inflation became policy. Debt became the foundation of the global economy. This was the moment the illusion matured. Without gold to restrict creation, money could now be produced endlessly. Governments could borrow infinitely. Banks could lend without restraint. Central banks could manipulate markets directly. Money stopped being real and became a tool that would ultimately tilt the entire economy toward those who controlled it. With fiat money came a new era, the financialization of everything. From the 1980s onward, we saw Explosive debt growth, deregulated banks, complex derivatives, stock buybacks, mega mergers, outsourcing asset inflation, wage stagnation. This wasn't random. It was the system revealing itself. When money could be created by typing numbers on a screen, something predictable happened. Those with access to cheap credit bought assets. Those without credit paid rent to them, and wealth began flowing upward faster than ever recorded in history. Let's look at the numbers. In 1980, the richest 1% owned about 25% of US wealth. Today, they own more than 45%, the highest concentration since the Gilded Age. Global debt in 1970, $2.5 trillion. Global debt today over $300 trillion. And here's the real twist. Debt grows faster than the economy. Asset prices grow faster than wages. The wealthy own the assets. Everyone else pays for them. It's not an accident. It's not a flaw. It's the invisible design. As the system matured, three major fallout patterns emerged. 1. Wages stagnate while prices explode over 40 years. Productivity skyrocketed. Corporate profits soared. CEO pay rose 1,200%, but median wages barely moved, adjusted for inflation. Why? Because money creation inflated assets, not incomes. 2. Housing became a wealth extraction machine. As interest rates fell for decades, home prices soared. Not because houses got better, but because credit became cheaper. This benefits banks, developers, institutional landlords, investors, and hurts families, renters, first-time buyers, young generations. 3. Crashes became more frequent and more profitable. 2000.com crash, 2008. Housing crash, 2020. Pandemic crash, 2022. Inflation shock. Each crisis followed the same pattern. Assets crash, ordinary people lose homes, jobs, savings, central banks print trillions, liquidity, floods, financial markets, the wealthy buy assets cheap. The cycle restarts if you look closely. Each crisis transfers wealth upward more efficiently than the last. This is the gravitational pull built into the system. Governments have tried raising wages, regulating banks, cutting rates, raising rates, stimulus checks, quantitative easing, consumer protection laws, higher taxes, lower taxes, welfare programs, market reforms. None of them fix the core issue. Because the issue isn't wages, it isn't regulation, it isn't inequality, it isn't greed. The issue is structural. The system itself requires wealth to flow upward. Why? Because debt must be repaid upward, interest flows upward, asset ownership sits upward. Inflation erodes, savings downward, crashes create buying opportunities upward. Central bank policy stabilizes asset owners first. Every solution reinforces the structure. Stimulus gives people cash, but asset owners receive the inflation. Key boosts financial markets, benefiting investors, not workers. Rate hikes crush borrowers, but reward lenders. It's not personal, it's structural. A machine does what the machine is built to do. Today, the illusion is entering its most powerful form yet. Programmable, trackable, digital money. Central bank digital currencies, CBDCs, are being tested worldwide. They promise faster payments, cheaper transactions, more stability, but beneath the surface, they offer real-time surveillance, spending controls, automatic taxation, location restrictions, expiration dates, behavior-based financial penalties, and who controls the rules? The same institutions that engineered the last century of upward wealth flow. CBDCs aren't a new system. They're a new upgrade to the existing system, a system that already created the greatest wealth gap in modern history, turned basic needs into financial assets, transformed crises into profit cycles, linked debt growth to economic survival. Now imagine that system with programmable money. The illusion becomes unbreakable. 1. The financial system isn't broken, it's self-reinforcing. Its structure naturally channels wealth upward through debt, interest, inflation, and asset ownership. 2. Every major economic reform of the last century moved in one direction: consolidation, more centralized money, more centralized credit, more centralized control. 3. The digital age doesn't fix the illusion, it fortifies it. Programmable money is the ultimate tool for maintaining the upward flow of wealth. For over a century, we've been taught that the economy is neutral, fair, rational. But the deeper you look, the more you realize, it's not a neutral game. It's a design that rewards those closest to the money spigot, and extracts from everyone else. The illusion isn't that wealth flows upward. The illusion is that it was ever meant to flow any other direction. If this breakdown helped you see the financial system in a new way, share it with someone who still believes the economy is fair. And if you want more deep dives into the hidden mechanics behind money, debt, global systems, and modern financial power structures, subscribe, turn on notifications, and stay tuned, because in the next episode, we're exploring the biggest lie ever told about economic growth and why the truth is far more shocking than you think.